good vlog. Welcome back to another educational video. I know it's been a minute I've uploaded an educational content here on YouTube. Been away for a long time, been cooking some deeper shit for you guys. So today, getting down to the business, today I'll be bringing a very vital and very informative topic that I want to clarify so that can help people out there to better their trading approach. This is algorithm pricing. Algorithm pricing is just simply setting the price of an index, like setting the desired value of an index via algorithm programming. And this particular thing is majorly used in the CFD space. For you that don't know, I am a day trader and I trade CFD majorly. Yeah, other the likes of stocks, crypto, forex pairs and futures, but I major in CFDs. So for my 5x experience trading the CFD market, it's a simulated market and it's a market that's driven by liquidity itself. So that brings me down to my point. I'll be going through 3 points so that I can hit the nail on the head. So algorithmic pricing relating to traders having a directional bias on the market, like you coming into the trade, coming to the market, trying to see what setups you take. You as a trader now have to know where price is coming from and where price is going to, like which previous liquidity has the algorithm taken out and what's the next hunt that the algorithm is after. Then the way I like to view it is that the algorithm prints price from the area of lower liquidity to the area of higher liquidity. So now my mindset is already positioned to know that it's a hunt. The whole trading game is a hunt. It's usually you hunt or be hunted. So now I know that I have to find a setup that has an opposing liquidity so I can trade alongside the algorithm. Because mind you, the algorithm is way smarter, and I don't know how to put that, but it has a specific way of doing things the right way. That's when you remember if you take a stop loss, if you take a loss now, and you to yourself, you saw all your confluences, but you took a loss. But now when you're explaining that loss to yourself, you now say, oh, this is the reason why. So at the end of the day, the algorithm is always right. So the only issue there is that your target, your proposed target, has no liquidity there. You are the inducement that the algorithm has set to take out or set to hunt. So understanding this and understanding how the algorithm works helps you better your approach to trading the financial market in general, not always CFD. Because now you're coming to the market with the mindset of, who am I taking out today? That's the truth. Whose money am I taking today? Am I taking via the sells or the buys? And how you can that I've covered the point of the first one. My second point is how you can navigate the the algorithm direction. Okay, you know that popular price movement is likely an inducement. Remember this: for price to buy, there has to be a counter opposing sell. For price to sell, there has to be a counter opposing buy. So now, if everything from higher time frame, blah blah blah, everything is saying buy, just know that millions of traders are also seeing buy confluences. So if everybody is buying, where's the money coming from? That's just the truth and the reality about the market that most people don't want to accept. It's just the truth. So not saying that price will not continue a strong trend, because probably price might have a higher time frame draw in liquidity and it's trying to get to that place. But for price to get to that place, there have to be a constant inducement of sales so that price can continue source liquidity to go higher. So with or without without liquidity, price cannot move. The algorithm pricing cannot print new price. That's why we find price moving in a consolidation phase for a very long time. Why? Because there's no liquidity to either push price higher, or everybody have a general view causing some kind of equilibrium in the market. So that's my two major points in this thing, in trading. So this whole concept of algorithm and how to catch it, for a fact, you cannot observe this whole thing if you don't focus. When we're trading, people are nonchalant in trading. They just come to look for patterns. Why not? You're not studying to see who price previously haunted, the positions that were previously haunted, whether it's a buy or a sell that was previously haunted. That now will now help you to know which or know who will be the next hunt. And you can do this by utilizing time frames, scaling down from the higher time frame to the lower time frame. That's how I do my analysis. I scale down from the 1 hour, from the daily. I use the monthly, but it's when I'm looking for a larger picture. That's my own personal view. I scale down from daily time frame to the 4 hour, to the 1 hour, to 10 minutes. That's why I make most of my executions. So that has helped me to gather information from time frames, and it helps me impute a proper bias towards the market. Either with whatever outcome that comes out, the outcome is random. I won't blame you on the strategy, whether it's a win or a loss on that particular approach. I will always get to find out that me locking in on that particular chart, then you have that whole moment that how did I not see this? So you can see, so that's how that deep work comes in. You have to key into the chart, not just come here to look for price patterns and stuff like that. You have to key into the chart, locking for real. You have to lock in your whole eyes, your whole perspective, just locking when you lock in analyze, doing it a business, something so serious. You get to price gets to unveil itself to you. Then you have in your head all this questioning that some people's if you want they're analyzing, they speak out. Some people is all over in their head. You have all this thought process roaming. I know I'm yapping so much, but it's all these little informations that correlate or expands a particular particular sentence or a particular word. So as a trader, you just have to understand the algorithmic pricing, the algorithm itself, how it generates price, how it takes out liquidity, how it induces liquidity, because this alone betters your whole trading game. It gives you an edge. This is an edge alone. Understanding the algorithmic price is an edge alone. This helps you scale for real. I use it, so I've seen result that it has brought through me, and this brings me down to adaptability. When you understand the algorithmic pricing, you now can adapt to price better. You can be flexible. You can know when to apply certain things and when not to apply certain things, according to your system and the model you trade. Analyzing historical price movement helps you see what price has previously done. Then you taking in previous price action that price has printed now helps you better your trading approach, because to understand the algorithm better, the only formula to understand the algorithm better is by consuming as much historical price action as you can. That's why backtesting is so important, and forward testing is so important. I forward test more than I backtest because I love forward testing, because forward testing I get to prove myself wrong and right, so it helps me improve. So the last point and the last way to solidify your understanding about algorithmic pricing is to consume as much old price actions as you can get. Just make sure you know much about what price has done, or how price do it, and study the patterns in which it does it. Like structurally, like jot down your journal, like draw it out, how you see how price, like the way I started this whole thing, when I was like beginning my journey to understanding revenue pricing, I begin to ask myself, why did price buy, why did price sell? So these questions led me to understanding and unveiling, and giving me clarity to, via the Holy Spirit, giving me clarity to understand the algorithm pricing, which has better aided my trading journey, better aided my trading approach. So that's why it's very so important for traders to backtest and understand how price moves from areas of low liquidity to areas of high liquidity, how price induces traders, how price reacts to like supply areas and demand areas. This alone shapes your whole trading view, and it gives you a better edge. It's an edge, so this improves your edge in trading, improves your general view in markets or analysis, how you approach your analysis. You're locking into the charts to find the next draw in liquidity, not to find patterns, except that pattern shows you that your particular bias about that pattern is the next draw in liquidity. So it's not like pattern doesn't work. It works, but it only applies to when there is an available draw in liquidity there. So that being said, do like and subscribe. I'm rooting for you all, and peace out.